Hello friends, welcome back to another important lecture. Now just imagine you are a CEO of a growing company and you need an expensive industrial machine for your operations. But here's the catch. You don't have enough funds to buy it right now. What do? You take a loan and increase your debt burden, or is there a smarter way to acquire the asset? Friends, that's where leasing comes in. A powerful financial tool that makes businesses use high-cost assets without owning them right away. So in today's lecture, we will break down equipment leasing and lease financing chapter from your JAIIB accounting paper. This is one of the important chapters in the financial management part of your paper, and in every exam, IFBF puts one or two questions from this chapter. So please pay special attention in today's lecture. We will also solve exam-oriented conceptual questions and numericals toward end of this lecture. So stay till end of the session to get full exam ready. Now friends, before moving ahead with the lecture, don't forget to get your JAIIB Success Blueprint, which is a free 399-page exam cracking ebook just for you. It's packed with case studies, numericals and key questions from all the 4 papers of JAIIB. This is in fact compilation of most important case studies and questions from my hours of YouTube videos specially designed for all the JAIIB aspirants. So save time, study smart with this ebook. Download now, the link is there in description and pinned comments. So let's start with today's lecture and we will start off with the basics first. Friends, when companies need fixed assets like machinery, vehicles or buildings, they usually have 2 options. First is buy the asset using debt or equity, and second is lease the asset without owning it. Leasing is basically an alternative financing option that allows businesses to use an asset while making periodic payments to the owner. This means companies can conserve their capital, maintain liquidity and avoid heavy upfront cost. Formally, we can define a lease as, a lease is a contract where the owner of an asset, which is called a lessor, allows another party, which is called a lessee, to use the asset for a fixed period in exchange for lease payments. The key point to remember here is that the lessee gets the right to use the asset, but ownership remains with the lessor. Examples of leased assets include, first is real estate, then industrial equipments, vehicles, and also office equipments. Now that we have understood what a lease is, let's talk about its features. Friends, a lease agreement has some unique features that sets it apart from regular assets ownership. First is that it is a legally binding agreement. Friends, a lease is a contract that legally defines the rights and responsibilities of both the lessor and lessee. Then second is regular lease payments. That is, here the lessee pays periodic rentals ensuring steady income for the lessor. The next is ownership versus usage. Friends, here the lessee gets the right to use but do not own the asset. The next is fixed lease period. So here the lease contract is valid for a specified period, after which the asset is either returned or purchased by the lessee. And lastly, we have legal consequences for the breach. That is, if the lease terms are violated, the defaulting party can face legal action. Now friends, before moving ahead with the lecture, don't forget to get your JAIIB resources from the links given in description of this video. All these are hard copy 1000 series question banks of all the 4 papers of JAIIB delivered straight to your location, be it urban or rural location, without any shipping charges. All the question banks comes with lots of numericals, case studies and questions which are very important for your examination. With this material, you get comprehensive exam level question practice, and that makes you best prepared for your coming JAIIB examination. I update all these question banks after every exam, so always get updated editions. All the links are there in description of this video, so do get these amazing hard copy books after you finish this lecture. Now let's continue with our lecture. Next, let's move on to the types of leases. Friends, understanding the types of leases is crucial because different lease structures impact financial statements, taxation, and business decisions. So, as per Accounting Standard 116, leases are classified into 2 primary categories. First is operating lease and second is finance lease, or this is also known as capital lease. First, let's understand the operating lease. So this is a lease where the ownership, risk and rewards of the asset remain with the lessor. while the lessee pays for the usage. So the key features of an operating lease are, first is the lease period is shorter than the asset's useful life. Then second is the lessor maintains the asset, that is repairs, insurance and maintenance. The next is the lessee cannot claim depreciation, only lease rent is treated as an expense. Then next is it is commonly used for office spaces, vehicles and short-term rentals. And lastly, at the lease end, the asset is either returned to the lessor or renewed. Next friends, the example of an operating lease can be, suppose a company leases printers and laptops for an IT service provider for 3 years. Please note, since the ownership remains with the provider and the company only pays for using them, this is basically an operating lease. So when to use an operating lease? Now the first scenario can be when the company doesn't want long-term ownership risk. Second is when the asset depreciates quickly, for example IT equipments, vehicles. And lastly, when frequent upgrades are required. Then next type of lease is finance lease, or which is also known as capital lease. Friends, a finance lease, also called a capital lease, is where the lessee gets most of the economic benefits and risk of ownership, even though the lessor still holds legal ownership. Next, let's see the key features of a finance lease. First is this lease covers most of the asset's useful life. The next is the lessee bears maintenance, insurance and repairing cost. Then next is the lessee records the asset on their balance sheet as a right of use asset and a lease liability under Indian Accounting Standard 116. Then next is the lessee can often purchase the asset at the end of the lease at a discount price. And lastly, it is commonly used for expensive industrial machinery, aircraft or equipment that businesses want for a long-term use. So the example of a finance lease can be, suppose an airline company leases an aircraft for 15 years. Even though the aircraft legally belongs to the leasing company, the airline controls it, bears the operational cost and uses it for most of its economic life. So this makes it a finance lease. So when to use a finance lease? Friends, you can use finance lease first when the business needs long-term use of the asset. Second is when purchasing outright is too expensive but ownership benefits are required. And lastly, when the asset has a long useful life and does not become obsolete quickly. Next friends, apart from operating and finance lease, leases can also be classified based on their structure and parties involved. One of such lease type is leveraged lease. This is a lease where lessor borrows money to acquire the asset and then leases it to the lessee. Here the lender has rights over the asset in case of default. Example can be a leasing company takes a bank loan to buy an expensive crane and then leases it to a construction company. Another point to note is that this type of lease is generally used for high value assets like aircraft, ships and industrial plants. Then another type of lease is domestic lease. Here all parties, that is lessor and lessee, are from the same country. This type of lease is subject to local leasing laws and taxation policy. Example can be an Indian company leasing a vehicle from an Indian leasing firm. The next is international lease. As you can guess, here either the lessor or lessee is from another country. This type of lease involves currency risk, taxation differences and cross-border legal complexities. Example can be an Indian airline leasing a Boeing aircraft from a US leasing company. The next category of leases is cancelable versus non-cancelable leases. Now in case of cancelable lease, the lessee can terminate the lease before maturity under certain conditions. This lease usually comes with a penalty for early termination. Example can be a business leases office space with an option to exit after 3 years with a 6 months notice period. The next is non-cancelable lease. Now this lease cannot be terminated before the end of contract. So this type of lease provides certainty for both lessor and lessee. Example can be a company leases a factory for 10 years with no exit option. Next category of leases is wet lease versus dry lease. Now in case of a wet lease, the lessor provides the asset along with its operational services like maintenance, insurance, crew, etc. Another point to note is this lease is generally used in airlines, industrial equipment and logistics sectors. Example can be an airline leases a plane along with pilots, cabin crew and maintenance staff. On the other hand, in case of a dry lease, the lessee takes full responsibility for operating the asset. This type of lease is generally used when the lessee has in-house management capabilities. Example can be a transport company leases trucks but maintains and operates them independently. So friend, out of so many types of leases, we just saw how to choose the right lease. Now, choosing the right lease depends upon the business needs. So for short-term usage, we will generally use operating lease. Then in case of long-term asset control, we can use finance lease. Next, if we are leasing internationally, then we can use international lease. Next, if we don't want maintenance cost, then we can use wet lease. On the other hand, if we want full control, then we can use dry lease. So with this, I hope this breakdown of types of leases is crystal clear to you. Next, let's see the rationale for leasing. That is, why companies prefer leasing. Friends, leasing has some major financial advantages over purchasing. Let's see why. First reason is no heavy upfront investment. As you can see, leasing allows businesses to use assets without larger capital outflows. The next reason is tax benefits. Friends, lease payments are tax deductible expenses. And this also reduces taxable income. Then next is avoids risk of obsolescence. Now in industries with rapid technology changes, leasing helps avoid investing in assets that may become outdated quickly. Then next is flexibility. Friends, lease contracts are easier to modify compared to bank loans. And the last reason is it preserves borrowing capacity. So as you can see, leasing doesn't impact a company's debt levels as much as a loan. So with these advantages, many companies prefer leasing over buying expensive assets. Now let's look at the key contents of a lease agreement. Friends, every lease agreement must include these important elements. First is details of parties. Now this must include names of lessor and lessee. Then next is asset description. This should include information about the lease equipment. Then next is lease tenure. This part should include start and end dates and also renewal terms. Next important thing to include is payment terms. This should include rent amount, payment frequencies and penalties. The next is repayment and maintenance. That is, who is actually responsible for maintenance. And lastly, we have legal clauses. This should include termination rules, dispute resolution, arbitration, etc. So before signing a lease contract, both parties must carefully review these terms to avoid legal disputes. Next, let's talk about the tax and accounting implications of lease transactions. Friends, understanding the GST and tax implications of lease transactions is crucial because lease payments have different tax treatment under goods and services tax and income tax laws. And this is very important for your examination. So let's break this down in a simple and structured way. So the first question is leasing taxable under GST? And the answer is definitely yes. Under the CGST Act 2017, Section 7, leasing is considered a supply of goods or services and is therefore taxable under GST. Please remember this key rule that there is no distinction between an operating lease and a financial lease under GST. Both are taxable. However, the applicable GST rate depends upon the type of leased asset. Next, let's see GST rates on lease transaction. So please remember this important table for your examination. Now the first column includes the transaction type and the second column shows the GST rate. So in case of lease of industrial plots by State Industrial Development Corporation, that is SIDC, the GST rate is nil. For lease of agriculture machinery or vacant land, the GST rate is also nil. For lease of commercial buildings, vehicles and equipment, GST rate is 18%. Next, for lease of motor vehicles for transportation, lease is 5% or 12% depending upon the type of vehicle. Next, for lease of residential property for business purposes, the GST rate is 18%. And lastly, for lease of IT equipment, machinery, plant and equipment, the GST rate is also 18%. Next, friends, you must also remember these very important points. First is, if a property is leased for residential use, no GST is charged. Next, leasing for commercial properties, machinery and vehicles, as we have seen in the table, GST rate is 18%. And lastly, in case of reverse charge mechanism, that is RCM, the recipient of the lease service must pay GST instead of the supplier. Next, let's see GST implications for both lessors and lessees. First is GST treatment for lessor or asset owner. Friends, as you know, the lessor is providing a leasing service, so they must first charge GST on lease payments. Next, file GST returns regularly, that is GSTR1 and GSTR3B. And finally, they must pay GST based on the type of lease asset. For example, a company leases a commercial office space for Rs 1 lakh per month, then the lessor must charge GST at the rate of 18%. So the total invoice amount will be lease rent, that is 1 lakh, plus GST at the rate of 18%, that is 18,000. So the total payable by lessee will be 1,18,000. Next, let's see the GST treatment for the lessee, that is user of the asset. Friends, as you know, the lessee is the recipient of the lease service. So they must first pay GST along with their lease payments. Second, claim input tax credit, that is ITC, if the lease is for business purposes. And lastly, maintain proper GST documentation and invoices. For example, a manufacturing company leases industrial machinery and pays Rs 50,000 per month as rent. So the lessor charges 18% GST, which is 9,000. Also note, the lessee can claim 9,000 as ITC, that is input tax credit, if the asset is used for taxable business activities. Also note an important point, if the lease is for a non-GST business, example a school, hospital or charitable trust, then ITC cannot be claimed. Next, let's understand how leasing is treated under income tax laws. First is income tax treatment for lessor. Friends, lease income is taxed as business income, but the lessor can claim depreciation if they retain asset ownership. Also remember, finance lease payments are not taxed as rental income but considered loan repayments. The example can be, suppose a leasing company owns a fleet of cars and leases them to a corporate firm. The rental income is taxable under business income and the company can claim depreciation on vehicles. Next, let's see the income tax treatment for lessee. Friends, lease rentals are fully deductible as business expenses under Section 37 of Income Tax Act. But the lessee cannot claim depreciation in an operating lease. And in a finance lease, the lessee treats the lease as an asset purchase, so they claim depreciation instead of deducting lease payments. Example can be, just assume a company leases a CNC machine for 5 years at Rs 2 lakh per year. So if it's an operating lease, then the company deducts Rs 2 lakhs as an expense each year. And if it's a finance lease, then the company capitalizes the asset and claims depreciation. So the key learning here is, for operating lease, deduct lease payments as an expense, and for finance lease, depreciate the asset and claim ITC on GST. Please note these very important points. IABF normally asks questions from these concepts only. Next, let's see the accounting of lease transactions under Indian Accounting Standard 116. Friends, understanding the accounting treatment of leases is crucial for financial reporting, as leasing impacts both the balance sheet and profit and loss account. The latest accounting standard governing leases in India is Indian Accounting Standard 116, which aligns with IFRS 16 and has also eliminated the distinction between operating and financial leases for lessees. So what is Indian Accounting Standard 116? Friends, Indian Accounting Standard 116 is the Indian accounting standard for leases issued by the Institute of Chartered Accountants of India, that is ICAI. It applies to first lessees, that is companies that lease assets, and second lessors, that is companies that owns and lease out assets. Remember, under Accounting Standard 116, lessees must record almost all leases on the balance sheet except first, short-term leases which are less than 12 months and second, leases of low-value assets. For example, laptops, printers, etc. Next, let's see accounting of leases in the books of lessee. Friends, under Accounting Standard 116, lessees must recognize two key elements in their financial statements. First is right of use, that is ROU asset. Now this represents the lessee's right to use the asset for the lease period, and this is recorded as a non-current asset. Then second is lease liability, and this represents the present value of future lease payments. The formula for lease liability is simply summation of future lease payments divided by 1 plus discount rate raised to the power t, where t is period of payment. For example, if a company signs a 5-year lease for office space with an annual lease payment of rupees 10 lakhs and discount rate of 8%, then using present value of annuity factor, that is PVIFA, we can calculate lease liability as rupees 10 lakhs multiplied by a present value of annuity factor with discount rate of 8% and time period is 5 years, which comes out to be 3.99. So lease liability will be simply rupees 10 lakhs multiplied by 3.99 equals 39.9 lakhs. So this company will record right of use asset, that is ROU asset, as rupees 39.9 lakh and also lease liability as rupees 39.9 lakhs. And this will split into current and non-current portions. Next friends, during the lease term, the lessee must record depreciation on ROU asset and interest expense in the profit and loss account. Now the depreciation on the ROU asset is calculated by using the relation depreciation is equal to ROU asset cost divided by lease term. Now, for example, if the ROU asset cost is given as 39.9 lakh and the lease is for 5 years, then annual depreciation will be simply 39.9 lakhs divided by 5 equals to rupees 7.98 lakhs. Next friends, questions are also asked on calculating the interest expense on lease liability. So if the initial lease liability is rupees 39.9 lakhs and the discount rate is 8%, then interest expense will be simply 39.9 lakhs multiplied by 8% equals 3.19 lakhs. So total profit and loss account impact per year will be depreciation will be rupees 7.98 lakhs and interest expense will be simply 3.19 lakhs. Friends, finally, at the lease end, the lessee must first write off the ROU asset if not renewed, and secondly, it must clear the lease liability if fully paid. Also, please remember these special cases. That is, first, if the lessee buys the asset, the ROU asset is converted into a fixed asset, and second, if the lease is extended, the asset and liability are recalculated. Next friends, let's see accounting of leases in the books of the lessor. So for the lessor, the accounting depends upon whether it is a finance lease or an operating lease. Now first, if it's a finance lease, that is lessor transfers ownership rights. Please note in this case, the lessor de-recognizes the leased asset from its balance sheet. Instead of this, it records first lease receivables, that is present value of lease payments, and secondly finance income, that is interest earned on lease payments. For example, if a leasing company leases machinery to a manufacturing firm for rupees 5 crores over 10 years, then the company records a lease receivables of rupees 5 crores at a discounted value, and also the company earns interest income over the lease period. Next, for operating lease, that is in this case lessor retains ownership rights. Friends, here the lessor keeps the asset on its balance sheet and the lessor records first lease income as rental revenue in the profit and loss account, and secondly depreciation on the asset. For example, if a real estate firm lease out office space for rupees 2 lakh per month for 3 years, then the firm keeps the property on its balance sheet and it also records rupees 2 lakh per month as lease income. Not only this, it also deducts depreciation expense from the profits. Friends, with this I hope the theory part is clear to you. Next, let's do some conceptual questions that will make the concepts crystal clear to you. And the first question is, which of the following correctly differentiates between an operating lease and a financial lease as per accounting standards? And these options are given to you. That is, first option is, operating lease allows the lessee to claim depreciation, whereas finance lease does not. Then second option B is, finance lease transfers ownership at the lease end, while operating lease does not. Then third option C is, operating lease requires the lessee to bear all maintenance costs, whereas finance lease does not. And lastly, option D is, there is no difference between the two as both involve periodic payments. Friends, as we have learned earlier in the lecture, that finance lease allows the lessee to substantially enjoy ownership benefits and may lead to ownership transfer at the lease term's end. On the other hand, operating lease does not transfer ownership, and the lessor retains maintenance responsibilities. Thus, the correct option for the given question is option B. Then second question is, a bank is financing rupees 50 crore power generation plant for an industrial client through lease financing. The bank wants to reduce the risk exposure while still earning lease payments. Which of the following lease structures is most appropriate for the bank? And these options are given to you. First option is finance lease with balloon payments. Then second option B is operating lease with fixed residual value. Then third option C is wet lease with full service maintenance contract. And last option D is leveraged lease with a syndicate of lenders. Friends, in large industrial financing, banks prefer leveraged leasing, where the bank, which is basically a lessor, finances only a portion of asset cost. Here, the remaining portion is funded by other lenders, which is generally known as syndicate financing, thereby reducing individual risk. Also note here, the asset itself acts as a collateral. Now, this structure is very common in aircraft, power plant, and infrastructure leasing. Thus, the correct option for the given question is option D. Then third question is, a company has signed a 6-year leasing agreement for a commercial property. The annual lease rental is rupees 12 lakhs and the discount rate is 10%. Given the initial lease liability using the present value of annuity factor, that is PVIFA, and it's also given the value of present value of annuity factor, that is for 10-year discount rate and 6 years is 4.355. Which of the following is the correct lease liability? And these options are given to you. Friends, as we have learned in the theory part, the lease liability is calculated using the formula lease liability equals annual lease payment multiplied by present value of annuity factor, which is nothing but 12 lakhs multiplied by 4.355 equals 52.26 lakhs. So the correct option for the given question is option C. Then next question is, which of the following lease agreement does not require a right of use asset and lease liability recognition under Indian Accounting Standard 116? And these options are given to you. First option is a 10-year lease of industrial machinery costing rupees 50 lakhs. Then second option B is a 5-year lease of office premises with an annual payment of rupees 20 lakhs. Then third option C is a 6 months lease of IT equipment worth rupees 1 lakhs. Then last option D is a 4-year lease of factory land for rupees 15 lakhs per year. Now friends, as we have learned in the theory that as per Indian Accounting Standard 116 provides 2 exemptions. First is for short-term leases, that is less than 12 months, and second is for leases of low-value assets. Now, since option C involves a short-term lease of 6 months of low-value IT equipment, it basically qualifies for exemption and does not require a ROU asset and lease liability. Thus, the correct option for the given question is option C. So friends, finally we have reached the last question of the lecture, and the question is, a company has recorded an ROU asset valued 30 lakhs and a lease liability of rupees 30 lakhs for a leased warehouse under Indian Accounting Standard 116. The lease term is 5 years and discount rate is 8%. Calculate first annual depreciation and second first year interest expense, and these options are given to you. Friends, as we have seen in the theory that depreciation is calculated as ROU asset divided by lease term. So for this question, it will be rupees 30 lakhs divided by 5 equals rupees 6 lakhs per year. And interest expense is nothing but lease liability multiplied by discount rate, which is equal to rupees 30 lakhs multiplied by 8% equals rupees 2.40 lakhs. Thus the correct option for the given question is option A. Friends, with this I wind up this lecture. I hope this very important concept of lease financing is clear to you. And also all the conceptual questions as well as numericals are also clear to you. Lastly, don't forget to get your JAIIB resources from the links given in description of this video. So thank you, and I will meet you again in another video.